So that's the geopolitics. Let's also bring in now Jim Bianco. He's founder and president of Bianco Research. Jim, first of all, I'm so excited to see you in London. Thank you also for all the great chart analysis that you send us on a weekly basis. Where are we now? So there's the economy is holding up, but there are signs to the downside, and then the market is doing something else.
Yeah, I think the real question is are we going to have a slowdown or a soft landing or a recession? That has been the call for the last 18 months, and it has largely not come to pass. And I guess the question we have to ask is, why does the economy, to use Jay Powell's phrase, surprisingly resilient? Right. And I think the answer is consumer spending. The consumer continues to spend. Why does the consumer spend? I think we don't appreciate what happened in 2020. With the shutdown restart of the economy, people have a different attitude about jobs. They're more transactional about jobs. They feel like they can quit their job, they can get another job, so they're very comfortable with spending. I don't have to worry about being unemployed for a lengthy period of time. If I self-unemploy, if I decide to quit, I can get another job. So spending keeps coming and coming and coming, and the economy continues to stay resilient. And until about 2 weeks ago, the bond market was responding by ever higher interest rates to that.
But so first of all, if we take a step back, is this on credit card or is this also money pent up during COVID where we didn't go out so much? Because if that's the case, then at some point it kind of dries out.
Yes, it's a little bit of both. I mean, we're still struggling to figure out how much post-pandemic excess savings we still have. Yeah. And most of the new research coming out is suggesting that there's a little bit more than we have. And there has been an uptick in credit card spending, but I think really, it comes down to an aggressiveness by consumers that they are willing to spend revenge travel or whatever phrase we want to use because they're not concerned, at least at this point, that they're going to lose their job and that they're going to have to retrench.
Jim, I know you sent some great charts. So we got one made actually looking at expectations for GDP in the third quarter of 2023 compared to what we're expecting for 2024. Now, what's interesting to me, Jim, is actually if you look at expectations, I mean, even in the last 12 months, they've been all over the place. I mean, we're expecting a recession. You know, we have all these like mountain tabletop also kind of analysis.
Yes.
Like, how are you so sure that it doesn't get really ugly from here?
Well, what you've been seeing is this repeating pattern, because what the chart just shows is Q4 and Q1, that the expectations for GDP are being revised up and up and up. Yeah. This is maybe the sixth or seventh quarter in a row that this exact pattern has been happening. Right. When we look at the economy, out 6 months, we say contraction, possibly recession, and then in 6 months, it never happens, right. And then it's contraction, possibly recession, and it continues and it continues. And I don't see anything yet on the horizon that suggests that that pattern should change. The stock market's not down. I don't believe interest rates, even at 4.5% on the U.S. 10-year note, are at injurious levels for the economy. There's nothing that has yet broken, the old line that, you know, something breaks for the economy. That hasn't happened. We survived the banking crisis of the spring.
Okay, so if something breaks, where do you see it first? Because it is also odd, right? This is like CFA level 4, that you go from like 0.5 interest rates to 5% without anything breaking.
Yeah, it is, but you also have to remember that the 2009 to 2020 period was the abnormal period. That was QE. That was not only depress interest rates to zero, but in Europe and in Japan, take them to negative. So some of that 500 basis point rise, or maybe a majority of it, was just correcting the QE period, because we're not in a QE period. We're in a QT period. So some of that interest rate rise has probably been restrictive, but not nearly as much. What tells you something's broken? Historically, risk markets usually have a bad reaction, a very bad reaction to whenever you break something. They're not having a bad reaction. Neither credit is or equities.
So, Jim, what do you expect to happen for maybe the markets to shift actually on treasuries or bonds in general?
I've been bearish on bonds for a couple of years. I believe the 40-year bull market ended in August of 2020, so we're in year 4 of a bear market. We've had a relentless rise of rates until about 2 weeks ago. I see this as a natural correction in that longer uptrend. This could still run another several weeks, this kind of sideways to lower yields. But ultimately, I think we're going to make new higher yields in the first half of 2024. And probably around 5.5% to 6% is at least now where I'd put the fair value for the U.S. 10-year. So it's got another 100 basis points to go. And my concern is the Federal Reserve is not raising rates because they say financial conditions will do the work for them. Well, that starts at 5.5% in the way that I look at it. The markets haven't begun that move yet. And then it could be potentially higher interest rates even from there. That's if necessary. So I do, think that rates are going to continue to move up.
Yeah, and so what does that mean for the economy? Again, and we've seen a dispersion in credit. Does that just get worse?
Well, eventually you will get to that point where you get high enough that you will see a serious retrenchment in the economy. I don't think we're at that level here yet. But if you put rates at 5.5, you put mortgage rates in the U.S. pushing 8.5 or 9, they're about 7.75 right now. You might start to see even more retrenchment in the economy. You might then start to really open that discussion that the Fed hikes or rates go up until something breaks. We're not there yet, so that's why I think we have to go higher.
Jim, is China the big unknown? I mean, we're expecting it to be inflationary when it reopened. We haven't really seen that because there are so many question marks about their economy.
China is a huge unknown. We thought after zero COVID that there was going to be a boom in China. And in the first quarter, everybody positioned for it, and it never really materialized. So, yes, it has been somewhat of both on an economic front with its disappointment and on a political front, because we've seen a lot of companies, Google with their Pixel phone, moving to India as one example of companies that I think are telling us there's too much political risk right now to stay in China. So, yes, they do remain a giant wild card right now.
Jim, when it comes to financial conditions tightening, is there something that we're measuring wrong, or is it just that it basically takes longer time for interest rates to take effect?
I think what we're measuring wrong is what is the fair value of interest rates. The Federal Reserve, to use the Federal Reserve's measure, they think it's a 2% inflation rate plus 0.5% on top of that, which is what they refer to R star. I think that the inflation rate is more like 3.5, and that 50 basis points or 0.5% on top of that, given higher interest rates, more volatility, might be closer to 1%, so that the fair value might be closer to 4.5. Now, we're above that level, but that doesn't mean we have 300 basis points of restrictiveness, maybe 100 to 150, and that's why the economy is able to withstand that type of restrictiveness and why rates have to go higher.
Jim, thank you so much. So fun having you in London. Jim Bianco, their founder and president of Bianco Research. Now, coming up, Larry.